Wait, if you're waiting, you could have already made 50% in gold because it's moved from 1600 to 2500. If there's no need to wait on the sidelines if that's what you're sort of saying. Look at the charts and play the charts. Gold is in a clear uptrend, so there's no need to wait. You can be making good money in gold or in the stock market because gold and stock market performed equally for the last 6 years. So you could have made good money in both. What we're saying is that the capital rotation event will be confirmed by gold breaking out versus the S&P and moving above zero point 0.5. So once gold is worth 50% of the stock market, that's when you can really start thinking in terms of the true gold bull era, not bull market, but bull era, commodities bull era, that capital rotation taking place.
Hey guys, welcome back to Capital Cosm. Today I've got 3/4 of the four chartsmen in the form of Andy from Finding Value, Patrick Kareem from North Star Bad Charts, and Kevin Wadsworth from North Star Bad Charts as well. Gents, we've got a lot to talk about. At least I think so. There is some stuff to talk about, right? There's a few things going on in the world we can talk about. But I appreciate all of your time. I appreciate you, the audience, as well. And I'd like to remind you to hit that subscribe button if you're getting value out of these videos. It might not seem like much. It is free, but it does go a long way. So any support is much appreciated. Fellas, let's just jump right into it. No rules. Anyone can cut anyone off. Free flow discussion. What is going on in the economy? We had a pretty rapid sell-off last week, but it already feels like it happened 10 years ago at the time of this recording. Who wants to take this? Let's go with Andy.
Yeah, so I'm still trying to figure out what exactly happened, if this is going to continue or if this was a one-time thing where we get a large selling pressure move lower, and it's all done and said, and we're going to go back up. The yield curve, when you look at yields, they have dropped. They dropped quite precipitously, the 2-year yield. We did get a flattening of the yield curve where the 2-year and the 10-year are almost equal to each other now. And generally speaking, if the yield curve uninverts, we have unemployment going up. The unemployment rate, that's generally a precursor to a slowdown. So is this the beginning of something that's bigger? Big question mark. If you back out and you look at it from a long-term view, the answer is no from a long-term view. From a short-term view, is this the beginning of the thing that pricks the start of a slowdown or recession? It very well could be. It's difficult to say. I continue to watch the yield curve. I continue to watch the unemployment rate. And if the employment rate keeps going up, if the yield curve continues to, I'll say, uninvert or steepen, I would say a slowdown is definitely could be in the house of cards here in the short term to the medium term. But sometimes it takes some time to play out. It doesn't do it immediately. So people I know, normal people, retail people, they generally think things happen at light speed. These things usually take time to work their way out. And given all of this information that I look at and what I follow, I think now is a prime time for gold and silver to do incredibly well under for these market conditions. I think everything's kind of aligning with the tailwinds behind that sector. So that's kind of what I think at the moment, and that could change very quickly depending on what the yield curve does and unemployment. But as of right now, it looks like we're on the path to a potential slowdown. And I would say gold and silver is the sector that I like the best at the current moment.
Kevin, Patrick, which one of you guys want to take this one?
Yeah, well, I can talk about the yield curve there because there's a very good chart for that, as there is for, for most things, of course, Danny. So we'll take a quick look at the yield curve chart just to put some those comments that Andy made there into context. This is the 10-year minus the 2-year yield chart, and I showed this last time we spoke, and we talked about, or I talked about assessing the risk from this particular chart because the 10-year yield minus the 2-year yield has a pretty good history of being an indicator, if you like, for problems. And I said before, I'm not an economist, so I'm not about to tell you what kind of problem we're going to see in the economy, but it tends to be a high impact event that comes along when we've had an inversion on the yield curve, when this curve, which is usually above the zero line, falls below the zero line and then as Andy was saying there, uninverts when the uh, chart moves back above the zero line there. And we, of course, have had a protracted period of an inverted yield curve here. And we've had a consolidation for several months, many months actually. That consolidation appears to have ended with a breakout. And last week, the shockwave that went through the system as the inversion hit the zero line. Now it shows just how markets can panic and react when these sort of technical levels are reached. But I think in reality, actually, it's very often the case that when we cross the zero line there, the event, the real event, the thing that we look back on historically and say, well, that was a major market event, whether it's the GFC crash, whether it's the dot-com bust, whether it's the Asian crisis, whether it's the early 90s recession, it plays out not over days, not over weeks even, but over months. And so crossing that zero line doesn't necessarily mean that we're going to have an immediate sort of catastrophe, but it just means that stuff is breaking, something's likely to give way in the broader economy. So I've assessed the risk as being pretty high at the moment, as we touched that zero line last week. So we've got a high likelihood of a high impact event occurring within the next 1 to 3 months. Now, critical just how this chart reacts over the next few days and weeks, because the technical chart pattern that starts forming below this zero line, if it's a bullish pattern that is forming on the smaller time frames, then I'll keep this at a high risk. If we start to break back down again and we don't see some sort of bullish pattern forming below this red line, then that reduces the risk and that pushes the event out further into the future. And as you mentioned, Andy, gold is a great indicator as well. So you have to look at a weight of evidence. This is the gold to SPX ratio chart. So whilst you're looking at that yield curve inversion, you should also be looking at charts like this, which show the ratio of gold to the S&P. And as you can see, gold bull runs and those periods when the S&P and the stock markets plunge coincide with the gold to SPX ratio breaking out. And you can see the breakout here that took place back in the early 1970s. You can see the breakout that took place back in the early 2000s. And you can see the situation that we're in now. The gold to SPX ratio is pushing for a breakout. It stopped its decline. It stopped falling, and it's been going sideways now for around about 6 years. So the S&P has been unable to outperform gold for 6 years. It's just gone sideways. It's gone up, it's gone down, it's gone up, it's gone down. But overall, for 6 years, the stock market has not outperformed gold. That's the first prerequisite of the next stage. And the next stage of the roadmap is this thing breaking out and starting to signal, along with the 10 minus the 2 year yield and other charts, that we're seeing a major trend change. That major trend change will be a capital rotation away from stock markets and towards precious metals. So you only need to look at the gold chart itself to see exactly what's happening here. Now, the gold chart broke out at $2,000 back at the back end of last year and the early part of this year. Huge move up, and I'd sort of speculated it might be a $600 to $800 move up. Well, we've moved up $500 or so far, and we're getting very close to that target area that I'd suggested. Whether we require a back test all the way back down to 2100 kind of depends on what sort of market event we get, assuming that we do get some kind of market event over the next several months, perhaps into the early part of next year sometime. So that lies ahead. And this sort of target area is what we're just pushing into now. There are other reasons to suspect that once we get sort of somewhere between $26,000 and $3,000, that sort of major resistance in that region is likely to push price back in a more meaningful fashion. But that doesn't change the overall outlook for gold, and the overall outlook going beyond that for gold stretches way beyond $3,000 and beyond probably $4,000, with targets, reasonable targets in the region of $5,000 or even higher if we look at the gold bull market potentially peaking in the early 2030s as opposed to the late 2020s. So all of that lies much further ahead, and more evidence needs to be assessed to discern whether those higher targets are likely. But I'd be extremely surprised if gold doesn't at least double from here and quite possibly double again, which is exactly what it's done every time the gold to SPX ratio has broken out. It doubled again, and then it actually doubled again. So the pure mathematics of historical evidence would take us at least to $5,000 or $6,000. So that's gold. And silver, well, just to round off this particular bit here, silver's 45-year cup and handle pattern here, you just won't see a more perfect cup and handle pattern over a multi-decade time frame. We're nearing the completion of a 45-year event, which has seen this huge pattern building out. We entered the cup pattern in 1979, and here we are 45 years later, approaching the arc target of this little arc, this little cup, which is actually the handle on the much larger cup. So when you get a pattern like that, I sort of suggest that it's highly unlikely that this has been building out with the intention of not doing very much when it hits the target and breaks out here. So when we get to the $50 level, sort of 45, $50, once we start closing above that level, then you just need to look back at 2003, 2004 at what silver did when it broke out of an important resistance line there. Well, that resistance line went back, I don't know, maybe a couple of decades. This resistance line here goes all the way back to 1980. So the implications are significant for what would happen on a breakout of that pattern.
What about copper? If you look at copper, it's been actually showing some weakness over the last, I want to say, 6 months or so, while gold's been making high after high. In fact, if you look at the copper to gold ratio, you'll see that illustrated even more pronounced. What does that imply? What does a strengthening gold price and a weakening copper price mean?
Yeah,
And
so we've got,
yeah, go ahead.
yeah, sorry, Pat, do you want to, sorry, does someone else want to take that?
Yeah, Patrick, do you want to take this?
Go, Kevin.
Okay, yeah.
I'm enjoying the
Okay,
show and
well,
tell.
I can pull up the copper chart that I use for our website members if you just give me a moment. Um, okay, so the copper price, just give me a moment whilst I find the right chart. But the copper price is sort of testing the $4 area,
Mm-hmm.
um, and that area is important. And I'll show you why it's important if I can get the chart. There we go. So we've got another cup pattern on copper, and it's been testing that $4 area for a little while now, and it's just starting to show signs of breaking below the edge of this arc. You can see how this arc pattern guided copper all the way back to sort of the $4.50 region. And what I've been saying to our website members is that until $4.75 is broken to the upside, until we get a clear close, monthly close above $4.75, then the risks remain that we see some kind of sideways pattern or even a handle forming on copper. I'm not saying that's what's going to happen, but if you want to talk about seeing confirmation of copper going much higher, if you want to start getting excited about the copper price, you really need to get above this sort of shaded red zone on the chart, which is where you find the horizontal resistance. And so 475 is the kind of area that you want to be looking at. And if we break above that, the implication would be, and I should point out actually that when you get these cup patterns, sometimes you get a handle forming on them, and sometimes you don't. You've probably heard of the expression a cup and handle pattern. Well, a handle might look something like that on the top right hand side of the cup, and whether or not you get that pullback depends on cyclical behavior of the asset itself and other sort of factors like what's going on with the stock market, the broader economy, and gold and commodities. So if those markets that I just mentioned there are entering some kind of corrective pullback phase, then it's more likely you're going to get a handle here. So that is part of the technical evidence. But not all cup patterns have handles, and it's very often the case, as you can see from the one to the left-hand side there, that we had back in the early 2000s. We had a cup pattern that formed, and then copper decided just to catapult out of that cup and doubled in price and more than doubled in price. So uh, whether you form a handle or not is, as I say, subject to other market factors and other pieces of technical evidence. So $4.75 is my level there. My personal view at the moment, I suppose, would be, given that what seems to be occurring with the rest of the market and with gold and everything else, I suspect that support will hold, and I suspect this will slowly start to creep higher. But we don't really need to make that kind of sort of have that kind of biased pre judgment. We just need to observe the chart, and if we start closing down below $4, then there's a trend change that's taking place there.
Okay, Patrick, what's kind of like your overall take of the economy? I mean, anything you'd like to add on top of Kevin and Andy's analysis?
Yes. Well, to go back to Andy's, indeed, when the that yield curve starts going up, and the chart that Kevin showed, you could overlay the U.S. jobs initial claims, and it's practically the same chart. You could overlay the gold versus SPX ratio, so that's practically the same chart. You could overlay the miners and all these asset classes that are correlated to the yield curve inverted, correlated to the U.S. initial jobless claims, correlated to the gold versus SPX, and it goes after that. You could fit in, well, okay, there's going to be a slowdown, etc. So the more the initial claims go up, it spooks the Fed, right? It's part of their mandate there, whatever. It's what price stability and employment, right? It's part of their thing. They all go hand in hand, but again, there's no red line that's gonna make it. It's gonna happen. That yield curve when it started uninverting in 2007, silver melted up. You'll see that yield curve. It goes up months and months, almost a year. And if you would have been the doomsayer, oh, I can't go along silver now. It's gonna be recession while the market's still rocketing upwards. What are you gonna do? You can't be feared by paralysis of the yield curve uninverting. All it tells you is the low risk entries in precious metals happen when the yield curve is low and uninverting. That's where the low risk, the high risk entries for stock markets, the tops in stock markets often are when the yield curve is low and uninverting. And the low risk entries for stocks is when the yield curve is like top and starts unwinding. That's when you should start buying US stocks. That's when they put in important bonds, not all the time. And as that yield curve restarts going down, that's when the US equities just go bonkers, right? So that's my take on that stuff. You can't use that in a vacuum. If the gold chart's breaking out in an uptrend above a 12-month moving average, above a 36-month moving average, goodness, you're in an uptrend. If silver is doing in higher lows, you're in an uptrend. It's like you can't overcomplicate things. Like the biggest thing is people they always seek a narrative or something to decide whether or not they're going to dump in some money in something. But just look at the chart, guys. Like I can make TA so simple for you. Are you above an inclining moving average? That's all. It's mathematical, unbiased, and you could think it's going to bounce there or do that stuff. But at the end of the day, if it's the price keeps trending upwards, you're in an uptrend, no matter what the narrative is. So that's my takeaway for Andy's and a little bit bridging with what Kevin said. But this is the big Rosetta Stone, or it's gold has not broken out versus SPX yet. Copper, when it did its crazy run, you saw that Kevin showed you the run it did from 2000, 2001 all the way to 2007, and then it went sideways a little bit to 2011. Gold was outperforming SPX. When silver did its crazy run in the 2000s, gold was outperforming SPX. When the miners did their crazy runs, gold was outperforming SPX. Why do you think the miners are like not doing so good? They're trying, so I know some, but the index as a whole is not really taking off. It's because we don't have the full capital flows, the macro capital flows of money leaving US stocks to go into these alternative asset classes that we know. So the setup's like definitely there. Gold's what's like kind of baffling, but you got to respect it. The gold chart in itself, and it's in a bull market. It's been in a bull market since June of 2019, maybe a small stint when it was consolidating from 2020 to 2023, 24. That was a sideways, but gold in a bull market. But are precious metals in a bull era? No, no, no. Whatever gains you saw silver do right now, it's nothing compared to what it's going to do once gold starts breaking out versus PX. And that usually the instigation for that is a bear market for US equities, not a 10% correction. There's no damage done. US equities are still above their 12-month, 3-year moving averages. There's no bear market for US equities. None. Guys, and that's a little beef I have with Kevin's risk matrix. Kevin, I'm thinking about that. How could it be a risk event? You got to tell me what the risk event is, but the moving averages the stocks aren't even below declining moving averages. Like, I'm trying to make that fit. So are you saying we could have an event where a shock happens, but that event does not mean we're going to bear market, right?
I think it's based off the
I,
yield
I,
curve.
I think I think, Pat, it's a weight of evidence assessment that looks at how the yield curve is set up with that breakout from that flag pattern that could result in quite a rapid upside move. It's touched the zero line, but more importantly, and you mentioned it, the gold to SPX ratio, because the gold to SPX ratio breaking out would likely require the stock market to take a large drop. So it's more an assessment of that event of the stock market rolling over heavily in the next 3 months versus versus gold. So, gold, as you've already said, is in its own bull market, but that isn't going to be sort of on steroids without the stock market breaking down. Now, if, as I've said already, if that yield curve on inversion doesn't build another smaller bullish pattern below the zero line, then that risk starts to recede. And also, as you've quite rightly said, the stock market on its own chart is showing absolutely no sign whatsoever of a major problem. Yes, there's been a breakdown on the daily and the weekly timeframes. I think we've shown that previously on the weekly chart. There was a bearish rising wedge for Nasdaq, for example, and for SPX, and those have broken down. But that's just on daily and weekly timeframes. On the monthly timeframe and the quarterly timeframe, which are the ones that really matter, nothing is broken, as you said. It's above the rising moving averages and above the key support lines. And SSPX breaks down below 4818, that sort of previous high level, then I don't personally have any major issues with the stock market. So you're quite right. I think the risk assessment for a major market event is likely to be moved back down to a moderate risk, an ongoing risk. Should that yield curve not show any further signs of uninverting, because I don't think a major event will happen overnight when it uninverts.
Andy, do you agree with that analysis?
Yeah, the thing that I would look at is the 2-year yield to see if it's dropping. If we break out of structures on the 2-year yield and it continues to drop, it's going to uninvert the yield curve, and that's generally when you have a problem. We're also seeing evidence with gold breaking basically to all-time highs. We have silver that is well set up in its pattern, and I think it will just lag whatever gold does. We are seeing the DXY also start to drop, and that's also another indicator that yields will probably drop as well. So when you were talking about the run in copper and the run in commodities in the 2002 to 2007 timeframe, the dollar dropped during that time. And that's also when basically we had the slowdown. The original slowdown was from 2000 to 2001, that slowdown in tech stocks. We saw yields drop, the yield curve uninvert. We saw the dollar start to drop at that same time. And I think we're going through the same exact situation as 2000, 2001. If it started, I don't know if it's starting today. I don't know if it's starting 2024. I don't know if it starts in 2025. But I think everything is aligning for that to occur. The gold to SPX ratio, the gold to NASDAQ ratio, it doesn't matter which ratio you basically choose. It's gold versus some equities or financial assets. It's all starting to rotate. And if you're looking to try to buy what I would consider to be a really low point or a bottom, and I know that you can get stuck in it for a longer period of time, but if you're trying to buy an ultimate bottom, you kind of have to front run all these indicators that are starting to turn if you're trying to do that. So I think everything's aligning. It's all setting up for this to occur. And another thing that gives me more evidence is the unemployment rate that's starting to kick up. Whenever that starts to kick up, it seems like it finishes the cycle. It doesn't just, somehow miraculously turn and go back lower. We just haven't seen that in history. So if I look at this and I were to say, what's my best guess based off of the evidence that I see out in the markets, I would say that a slowdown is coming, but I don't know the exact timing of it. I would say that gold and silver, whenever you get the yield curve inverted and it starts to do what it's doing, it puts all the tailwinds behind gold and silver. And what are we seeing in gold and silver? We're seeing those break and move. So all the evidence that I look at and all the evidence that I try to find in the market is suggesting that a slowdown could be potentially be coming. I don't know the exact timing, but all the evidence suggests that. So I would agree with both of their analysis there. And I think a slowdown is probably going to come. I don't know if it's going to be big. I don't know if it's going to be small. I don't know how you could gauge that. And somehow these events that occur, 9/11 occurred when the yield curve was uninverting. COVID occurred when the yield curve was uninverting. All these quote events only occur when somehow the banks are all positioned in bonds already, And that's what we're tracking. We are tracking what is big money doing with their money. And what they do is they go and they front run the market. They jump in the 2 year yield. The 2 year yield drops, bond prices go up, yields go down. The big money jumps in front of the Fed, and then the Fed lowers the rates. And when they lower rates, that's when you get a slowdown in the market, generally speaking. And unemployment almost mirrors that as well. So it's not it's the beginning portion is when the slowdown generally occurs. It's when all this kind of like uninverts and yields drop. We get that slowdown kind of in the beginning. We could also get a slowdown in gold, silver, and some of these other commodities because you get like a sell everything type event where liquidity needs to get shored up somewhere, kind of yanks everything down. And I call that the slingshot, where it yanks everything down and then boom, it releases after that original kind of repositioning in the market, we'll call it, where you get that liquidity type event and a sell everything type event. You'll see the dollar drop, is my guess, and that dollar dropping is like the beginning stage of like kicking the commodity bull market off. Because the commodities, when you look at it, they're always priced in dollars. And it's like if the dollar drops against other currencies, which we almost always see in these commodity bull markets, you'll see a weaker dollar versus other currencies. So you're going to see like the Canadian dollar go up. You're going to see Brazilian real go up. You're going to see emerging markets rip. So I think all of that is in process, and we can look at those currency charts too because they look really good and looks like they're trying to base and make something because they've got big falling wedges. They're looking like they're going to try to break against the U.S. dollar. It looks like everything's in place that I can look for in terms of evidence and currencies because one is the commodity bull market is driven not only by the supply of commodities, the supply demand, but it's also driven by the denominator, which is the dollar. And then if the dollar drops, it's going to push all those prices higher and you get that big rotation of capital.
I could,
Yeah.
I could
Yeah.
show you some of those charts, the currency charts, if you want to see those there.
Yeah, go ahead and pull them up.
Right. Yeah, I had some thoughts. Andy like was talking in that. I had some thoughts on this. I have to mention this. I'm blanking out.
Do you want me to pull them up or?
Yeah, I could. I'll do some. I'll do some devil's advocate TA on them. Where is my?
Do you want me to pull it up or do you?
I have it. I have it. Do you guys see that? The
Yeah.
DXY.
Yep.
Yep.
So look, the DXY. I just showed this one to Kevin this morning. It's the monthly chart, log scale. This is distance from 36-month moving average. So if ever you're not able to outpace the moving average, essentially the capital flows are coming out, right? Because in the true bull era, you're always able to outpace the moving average and extend away from it, right? That's a low risk play, is to be somewhere where the price is able to always expand away further and faster from the moving average, right? We should all drive to hope to be in stocks or instruments, right, that are outpacing the moving average. So when you see here, like even back here in November 2020, that was the first step where the momentum for the DXY slowed down there. Since then, so often when that happens is sometimes it's hard to believe it. You always think the uptrends continue, but more often than not, you enter a consolidation period. And what that means is when you're in a consolidation period, it's a correction. And that means the price goes neutral. You're starting to oscillate. The moving averages now they're flattening out, and there's a risk because while people might see this as bullish, like this a continuation pattern, it could be, but it could also be a top because, like I like to say, is all tops start with shorter term corrections that just fail and cascade into something more terrible. So this is the U.S. dollar until the U.S. dollar is able to regain momentum and like start expanding above the 3-year moving average again. Yikes. But it hasn't broken down yet either. It's coiled. See, it's right above the 3-year, below the 1-year. This, like Andy said there, or even Kevin, it's man, this is like this. There's a setup there. Like you never front run a possible chart pattern. That's like rule number one, to never get trapped. Because anybody here who would try to front run it, they'd be trapped at 1 month, 2 months, 6 months. You would have been trapped years, But there is a resolution, man, that's coming. It's the setup's there. That thing is, I could tighten it up. I could go on the shorter time frames. But there's a setup here. If DXY breaks upwards, That's the market event that Kevin's talking about. DXY goes up, VIX goes up, everything sells. That's what's going to happen if that thing, if ever the DXY fails to break down here. It's like it's you better hold USDs, man, because that thing's going to be totally messed up. But if it breaks down, then this looks like the gold silver ratio. This is good for commodities. It's good for, it's going to save everybody, right? Because everything's denominated in USD. So to a certain extent, that's going to help anything denominated into a lower valued instrument. But here's the USD CAD. And this is my beef. I have the US CAD there. It's so close to breaking out. Breaking out. That's like crazy there. Like I've been eyeing this. I have an alert here. So this is not, it doesn't mean like commodities peak along with it. It doesn't mean they bottom along with it. There's periods where the USD CAD, it doesn't track to perfection commodities, but that thing, it does track the DXY pretty well because the DXY essentially is Euro USD. So this, if you think, like I'll overlay you guys the DXY so you get to see what I'm saying. New price scale. I'll put down the log scale. So look, it's pretty much a DXY USD CAD. Some people say, yes, it's a smaller percentage. So if you think if the USD CAD breaks to the upside, then the DXY has a higher chance of also breaking the upside. So now what you're betting on, people who are bears, the DXY, they're betting that it fails this breakout and it just plummets here, right? It just goes down through the 12-month, through the 3-year, through the cloud, and it goes down like that, right? That's what you're betting on, right? So, but it's getting close, man, to a breakout. Like it's closer to a breakout than a breakdown because even if you get, okay, this is another TA tip. Not all breakout lines are equal. So often we use the word breakout or breakdown and people associate, oh, it's a technician, a chart guy said it's a breakdown. It's going to go down forever. No, a flat trend line is way more important if there's a breakout above this because it's guaranteeing you're doing a new high. I think I'm repeating myself. So let's say I have a breakout of a horizontal breakout line. I'm doing a new high, lower, higher lows. That's an uptrend. You have more probabilities of having a sustained move upwards, more powerful move upwards once you break out of a horizontal breakout line. But here I have a line here. It's valid. But if it's a breakdown, it's a slanted line. So I'm not doing new lows. I'm just breaking the rising momentum, but rising momentum. I'm not creating new downwards momentum. I'm just halting that advance, right? Just like it did here. A lot of people could have said, oh, look, the DXY, it broke down, but it didn't break down and went to zero. What happened to the USD CAD here? It went sideways for years. So I hope people think like when we use the word breakout or breakdown, people have to look, okay, well, what are you talking about? What's the angle of the trend line?
How much of this chart is correlated with commodity prices? Meaning, you do have certain currencies that track commodity prices. One being the CAD, the other being the AUD.
Yes.
So when the CAD starts out from the dollar, that's usually your telltale sign that capital is rotating into commodities, right?
Yes, but not like I'll show you here. Okay, it's messy. Let me clean that up. Get rid of that. Get rid of that. Get rid of that. Get rid of that. Get rid of the DXY. And here, what I have is ASA, the gold and silver miners, the index. Oh, goodness. And the USD. Okay, no, where's my... This is the... There's one too many here. Okay. This is the ASA chart, algorithmic scale. I'm just going to move it down. Here is the USD CAD. I'll flip it. I'll flip the USD CAD, okay, to make it the CAD USD.
Okay.
Here. So when CAD is in a bull run in the 2000s versus USD, it's practically the gold and silver miner chart. You see that?
Mm-hmm.
Now it went down, but in the 70s, it wasn't that. The USD, the CAD got demolished by the USD in the 1970s or 80s, and the gold and silver miners still went up. Okay. So the correlations are not always there. And now look, it's diverging again. So you could have the USD CAD or the CAD break down versus the USD, and you could still have miners going up. So whenever you see charts like that, where the correlation is not 100%, it's evidence, but it's not your narratives of Canada's a resource intensive country. It tracks. It does, but not always, right? You have the proof here. It depends what type of cycle you're in, right? Tracks a lot, tracked on the way down. Now they're doing to do the alligator things there. The jaws, they're not tracking as much. In the 70s, there's periods where they tracked, some periods where they didn't. So that's a good that's how you have to see it there for the gold and silver miners there. So it's not it's not because the US, not because the CAD's getting demolished by the USD that commodities can't go up, right? It's look, if the correlation is there, but again, you're not trading correlations, you're trading the actual price charts, right? Because if somebody would have always waited for the gold to break out versus SPX, they would have missed the whole gold trade on its own price chart, right? But I'll tell you one thing: instruments that do track ratio charts, like a CAD USD is a ratio chart, and that ratio chart is breaking out in favor of your instrument that's tracking it, then you have more tailwinds than headwinds, and the stronger moves in shorter amount of times will happen during those periods. Just like silver's really strong moves happen when gold was outperforming SPX. It could have strong moves off bottoms while gold is not outperforming SPX like it's doing now, right? It's good, solid moves, but it's true bull error, like rip your face, closing 5% day after day after day after day, lock limit, like it in the 70s. That has a higher probability of happening once the ratio chart that you're correlated to is moving in your direction, right? That's like Kevin said, the weight of evidence. If you want to have less stressful, higher performing trades, you need to wait for that evidence.
Yeah, Kevin, what's kind of like your take on the overall commodity sector right now, with a with a potential high risk event in sight, vis-a-vis the risk matrix there that you've outlined? Where do commodities fit into all this?
Was that directed at me?
Yeah.
Yeah, sure. Well, commodities at the moment have been in a sideways consolidation for quite a long period of time, but the performance of different classes of commodities has been drastically different. So if you look at soft commodities like wheat and soybeans and all that kind of stuff, they've been absolutely awful, terrible, on a downtrend for forever. But we've seen some of the sort of metals and other commodities holding up pretty well, particularly, of course, gold and silver and other metals like tin, for example, and aluminium, aluminum, and all sorts of other sort of unusual asset classes. But commodities are doing pretty well. So when you look at oil as well, oil's been sort of hasn't collapsed, hasn't gone to the moon. It's kind of trending sideways. So that's in the consolidation phase as well. But I just wanted to pick up on what was being discussed there with currencies, because I've got a couple of charts that I think might be relevant for that. So I'll just quickly share the screen. So if you look at the Swiss franc versus the US dollar, the Swiss franc needs to outperform the US dollar for precious metals to do well. And of course, the Swiss franc has been outperforming the US dollar for a good period of time now, and gold has been performing well. And you can see over, in fact, the last 30 years or so, that the Swiss franc has outperformed the US dollar as a whole, just as gold has. So Swiss franc outperforming the US dollar, gold outperforming the US dollar. But we do have a resistance line that has just been confirmed, actually. I wasn't too sure about this resistance line because it relied on a couple of fairly tenuous wicks on these candles, but it was confirmed by price reaction at these couple of candles here, and then again this month, in fact. So this red resistance line is also active. But just going through the currencies, that's the Swiss franc. The Swedish krona is 4.2% of the DXY, and that's in a falling wedge. Canadian dollar versus the US dollar. I think Pat had it the other way around, the USD CAD. But you can look at it ratios either way up. But this is the CAD versus the US dollar, so it's on critical support. And Pat showed that when you flip it the other way up, it was on critical resistance. So the CAD USD is at a sort of a decision point here, and any further sort of downside action on this ratio chart will be a bad sign for commodities. The British pound is interestingly right on the verge of a breakout versus the US dollar. Now the British pound is nearly 12% weighting of the US dollar index, the index of currencies that the US dollar is compared to in the DXY. So the British pound, and also noticing some of the technical indicators are crossing into more bullish territory. This is the TSI indicator, the true strength indicator at the bottom here, which is a trend and momentum indicator for picking out overbought and oversold conditions. But crossing the zero line there, as you're right on a breakout point, that's a possible early sign that this is likely to break to the upside. And of course, if it does, then that's likely to put downwards pressure on the DXY. Japanese yen, interestingly, this chart has a false breakdown on a bullish descending pattern that's been going on for 15 years or more, I suppose this is. So this was a resistance zone. It's now a support zone or support lines. And we had a false breakdown there. Now, from a technical analysis point of view, a false breakdown is quite often a very bullish sign because the reversal tends to be quite rapid to the upside. We've seen that with the US 10-year yield a while back, of course. So false breakdowns can result in pretty rapid upside moves. So again, the true strength indicator is rising on this one. So that's nearly 14% of the US dollar index. And then, of course, the euro, which is nearly 58% of the index. And the euro is in a very much of a consolidation phase versus the US dollar. How this pennant plays out will play into how the DXY, the next move of the DXY. If this pennant breaks to the upside, then it follows pretty much as like night follows day that DXY will break to the downside. Also, I just wanted to bring Bitcoin into this, and I don't know how much of a fool I'm going to make of myself here, but I'll say it anyway because I've made a fool of myself a few times, so it's nothing new. We've been following this Bitcoin doom dome or dome of doom, and I don't want you to misinterpret it because it doesn't mean that Bitcoin is going to zero. It definitely does not mean that. It just means that that red line is a resistance. The red curve, perfect geometric arc, is a resistance line, and Bitcoin is perfectly capable of breaking out above it and going into a massive bull run to $1 million. Okay, that I want to get that out of the way first. This doesn't stop Bitcoin going to $1 million. But what it does tell us is where Bitcoin is going to go if it doesn't break out. Okay, think about what I just said there. This chart tells you where Bitcoin is going if the red line isn't crossed. Okay, if that red curve is not crossed, we know that Bitcoin is going down and down and down because it's trapped underneath it. So we need Bitcoin to break out above it in order for the next phase of Bitcoin's bull run to continue. Now, something is different this time. Okay, something is different, and people will be screaming at me saying, "Yeah, but the Bitcoin power law or whatever it is means that nothing is different this time." Well, I'm telling you, something is different this time because you can see very clearly that in previous Bitcoin cycles, these arc patterns that we all know about in Bitcoin that formed just catapulted upwards and outwards out of the arc. You can see the halvings marked the Bitcoin halvings and short-lived pullbacks followed by the rapid catapulting out of the arc. Same thing happened here. Bitcoin halving, the price of Bitcoin went up, then it went sideways just for a month or so, and then up it goes straight out of the arc, no handle needed. Now, this cycle is different in a number of ways. We all know about the way Bitcoin put in its all-time high by putting in what looked like the top of the cycle. It dropped from wherever it was, 69,000. It fell down to I forget what the value was there. It was somewhere near 35,000. So it fell about 50%. And then lo and behold, it made a new all-time high marginally. Interestingly, versus gold, it just equaled its previous high versus gold. Okay. But since then, as I said, so that was one difference. That was a different topping structure to previous Bitcoin topping structures. Something else is different this time is because the arc has not catapulted us out to new all-time highs. It's forming a handle if you're Bitcoin bullish, or it's forming a cycle top if you're not Bitcoin bullish. But you don't need to be bullish or bearish at this point. You just need to observe the evidence is the key point I want to make. Just observe the evidence, observe what is happening here. And that was a profit-taking zone. Now, Bitcoin reaching the top of the arc, that is a profit-taking zone. Okay, every time when the price reaches the top right corner of the arc, it's a profit-taking zone until you cross that threshold. And then on a weekly chart, this is the monthly chart, when you cross the threshold on a weekly chart, then you can turn more bullish on Bitcoin and play your whatever your strategy is to catch the rest of the bull run. Now, the rest of the bull run for Bitcoin this time isn't coming until we get above roughly 70,000. I've got it at 69,775, but let's call it 70,000. Bitcoin versus gold is an interesting chart because we price everything in dollars, but if you price things in gold, you often get a slightly different perspective. Now, your eyes might be drawn to the TSI indicator at the bottom here. I don't know if I had it on the Bitcoin chart there. I had these.
Wasn't that Bitcoin still priced in US dollars?
This is, yeah, let me just move on. Actually, yeah, thanks, Pat, for pointing that out. So this is the 2-week chart for Bitcoin priced in US dollars. Okay. Now, what I wanted to talk to you about here is the TSI indicator, the true strength indicator, again on the 2-week time frame. Now, what I'm looking for as a sort of a scientist, if you like, as a technical chart trader, is weight of evidence. I'm looking for what tells me something's different, and I'm picking up on there being something different with Bitcoin this time. So what I'm doing is I'm digging through the evidence here to try and find more evidence that something is different or that something isn't right. And this TSI indicator has never given us a bearish cross. Let me phrase this correctly. There has never been a bearish cross on the TSI 2-week indicator followed by anything more than Bitcoin going a few percent higher. That's the best way of phrasing it, because each time we had a bearish cross, Bitcoin either went into an awful bear market that saw the value of Bitcoin fall by well over 50%, or on one occasion, the third occasion here, the price of Bitcoin rallied marginally above, just by a few percent above the previous high point. So TSI indicator gave us the bearish cross, then it started to turn up and then failed and down it went. Well, we've had another confirmed bearish signal. I'm not going to call it a death cross because I hate that phrase, death cross. It doesn't mean disaster. It doesn't mean that Bitcoin can't go to $1 million. It just is giving us reasons to be cautious. And you can see the resistance zone on that chart as well, reasons to be cautious. Bitcoin versus gold, I just wanted to finish on this. And the whole point of mentioning this is we're talking about risk. We're talking about stock markets. We're talking about currencies in the US dollar index. And there being possibly an event on the horizon not too very far away. And I'm just wondering if Bitcoin failing to break out will be one of the early indicators, almost like front running the stock market in a way, because Bitcoin is highly correlated to the stock market. We know that Bitcoin follows tech stocks and NASDAQ pretty closely when you look at the correlation coefficients for Bitcoin versus NASDAQ. So I'm just looking underneath the surface here and starting to think, well, maybe if Bitcoin can't make a convincing breakout, is it telling us something that we need to be taking notice of?
Yes.
So one final statement. I know I've been talking about one final statement. If it does not break above that line, okay, we've got a problem. And we've got an even bigger problem if the Bitcoin to gold ratio breaks below the 3-year moving average, that green line, and the Ichimoku cloud there. If it pierces below that little orange circle, then we've got a more serious problem.
Is Bitcoin a leading indicator for the liquidity in the market?
That's what I wanted to say. Look, Bitcoin's important market tops are the Nasdaq requires Bitcoin to have put in an important market top. Bitcoin could put in an important market top. The markets could still rip higher, but the markets will not crash until Bitcoin puts in an important market top. Markets can top at the same time as Bitcoin puts an important top, but they will not top before. So because it's like down the asset, like money will leave Bitcoin, whatever, it's going to go flood into, the Magnificent Seven, like all the money goes back towards. So that's important. What Kevin showcased is, yes, canary in the coal mine. If in a healthy bull run, money should be flowing into all this stuff, right? Into Bitcoin and all that. Everybody should be happy. Everything should go up. So if Bitcoin puts in an important top, then it doesn't mean US stocks will go down, but that's like step one of a possibility of the US equities like having a severe market event. So that's important. And maybe before Andy maybe chimes in on that, I just remembered the metals will tell us the recessions. Like, let's say silver keeps going up, we could be in a recession at the start of one, but silver will bottom in the abyss in the worst of it, of the recession, which is often backfilled, right? Often we hear about the recession, but then they say, oh, it started a year ago. It's like, what? What's the use of that? But the metals will tell you. So as long as silver is going up, it's fine. If silver crashes and does a V shape, often you could overlay a recession chart and you'll see that silver bottomed the abyss of the recession, right? And started moving up before the recession ended. That's what's like, I have charts on that. I'm not gonna show you there, but they're like, they're everywhere. So that's my 2 cents on that there.
Andy, what do you think? Do you agree with that sentiment? And what does a lowered Bitcoin price imply for the market as a whole, in your opinion?
I think it's all interconnected. I think gold going up is a condition of the market conditions. And I think Bitcoin potentially topping is a resultant of a tech bubble maybe popping. So I think, yeah, it could be a leading indicator, or maybe the tech bubble already is popping, that we put in all-time highs and it's starting to come down. Now, calling tops is incredibly difficult. I'm not stating that I'm calling a top, but it could be, and Bitcoin could be more evidence of a potential top. What I'm seeing is it's very similar to 2000, 2001. We go into this overvalued state of technology stocks, which is where we're at today. We have this big overvaluation in technology. Gold is cheap and all the commodities are cheap, just like it was in 98, 99, 2000. We go and in the beginning of that, we had an increasing interest rate environment where, and I'll show you the chart here, I can share something. I've got the DXY pulled up, and I view things maybe a little bit different than those guys, but similar. So this is the bottom of the commodity to stock ratio. That's the bottom, and this is the top, just to show you. In the beginning, we had a rising interest rate environment here. So if I were to put maybe underneath it the US 2-year yield, so we had this increase here, and that's generally what drives strength and weakness of dollar. It's the monetary tightness or weakness against other currencies and their monetary tightness or weakness. So we had in the beginning in a stronger dollar in the beginning of that bull market of commodities starting to outperform um, equities. Then we had a big topping structure that broke to the downside, and we had a pretty big move in the DXY all the way to the bottom of 2008. And then your top of the commodity to stock ratio was right where this basically peaked for the dollar going down. So I think all of the commodities went up because of the weakening of the dollar. And it was us going through that cycle of increasing interest rate, a slowdown in the markets, and a bubble pop. And then that started or triggered a weakening of the dollar. In the beginning of these moves, like up here, you can have false breakouts and false movements in either direction for other currencies because it's going to be generally what occurs is you'll see like the Canadian US dollar. So this is the way that I view the Canadian US dollar. It's a little bit different than them. So I see two falling wedges over time. This was the breakout of '02 going upward. That was your commodity bull market. And I think what's coming is going to be a breakout eventually of this. Now, this could drop before going up. And the reason it could drop is because a lot of these other currencies, they are going to lower their interest rates before the United States might, which would cause weakness in those currencies. But I think eventually it will break to the upside, given that we're probably, I'm guessing, going through a technology bubble and commodities versus the technology stocks. And I'll just do like crude oil versus the Nasdaq Composite. I think these are basically putting in a bottom. So bullish Nasdaq crude oil underperforms the Nasdaq, so that's bullish Nasdaq. Bull oil, bear there, and I think we're basically squeezing for a potential breakout here any second for oil to outperform the Nasdaq. And I know that goes kind of counter to the narrative of a potential slowdown recession, and that's where things get all muddy because in a slowdown recession, generally crude oil will dip lower and then work its way on up. But I think this is all interconnected. And all of the charts that we look at are basically identifying what conditions are being subjected to the herd. And then the herd creates these patterns. So when we look at it from like a big picture view and we start to look at like different currencies, this is the Brazilian real versus US dollars. We have a big falling wedge that we've basically popped out of. And I think this is going to go up eventually with a weakening of the dollar. And that's also why I think, you look at something like an EWZ index, why we're basically, I don't know why that's down there, why we're squeezing up into a corner here and basically ready to break to the upside. It's because the dollar and what is about to be subjected to, we'll call it the herd. So it's the dollar weakness, it's the strength of those currencies, and how money flows when those currencies get these crosswinds starting to change. So what I think is occurring is tech is probably peaking out here at some point. Uh, Bitcoin is also uh, showing us that that could potentially be the case. Gold is starting to outperform the SPX. Gold is starting to outperform uh, the NASDAQ composite. Crude oil is starting to do that as well. I mean, this just looks like one big rotation in technology and stuff in America and a rotation out of American equities into other currencies. Now, I'm early on this. I'm not stating that it's going to happen immediately. And some of these charts haven't broken out yet. So I agree there, but I think it's all happening right in front of us. And there could be an opportunity with the yield curve uninverting, where if the yield curve uninverts, people get scared. There's a fear event that could occur. If you can see that event occur before it occurs, you can prepare for it. If you prepare for it, then you can take advantage of it, because if there is fear in the market and things were to sell off in these sectors that I think money's going to rotate into, I think you're going to get one heck of a buying opportunity if that occurs, because it'd be like a 2020 event. When did people make the most amount of money? They bought at the bottom of 2020 when there was max fear in the market. It yanked it all down. I call that a slingshot. It pulled all these things back and then shot it up after that event. I think something very similar could come. I don't know what the trigger will be or what the narrative will be around it. But when I look at all these charts, I look at how they're positioning. It's like, man, this is going to be one big rotation into emerging markets, other currencies outside of the dollar. We're going to see gold, I think, really start to outperform. I think silver is going to break that 50-year cup and handle pattern and just, I mean, rocket ship up. But we could get the best buying opportunity of everyone's life if we get the yield curve to uninvert, start that dollar to decline, and give you that last fear pullback of buying that you could get in the market. So I remain optimistic either way. If we break to the upside and we don't get that scare in the market, great. I'm in it. I'm going to ride it higher. If we get the yield curve to uninvert, the unemployment goes up, and we get a scare event in the system that yanks it all back, it's another, I think, insanely good buying opportunity to go long in a lot of these different commodities and emerging markets and stuff like that.
Is there an order of
That's my
operations that occurs during these commodity cycles? Like in 2020, we saw gold move first, and then energy,
Mhm.
and then the metals, the base metals. Is that typically the rule, or how does it typically work? Because not all the commodities rise at the same time, right?
You want me to answer that
Yeah.
or go to it?
Mhm.
So my opinion is when the yield curve moves up and down. It goes from inverted to, it uninverts and then it inverts. So when that yield curve moves up and down, it's describing what the herd is being subjected to. The herd is humans trading within the market, and it's telling us where we're at in the cycle. So as it cycles and inverts, the inverted yield curve means that you just went through an inflationary impulse move. It pushes the yield curve up and inverts it. And then when it starts to come back down, it's the slowing of inflation that basically that impulse move is slowing down. It's losing steam, it's losing momentum, and it could potentially uninvert. Uh, Generally, when inflation, you get that impulse move of inflation into the system, yields will chase it because it says, I don't like this inflation, give me more return, give me more return. And then it goes too high and it slows everything down, and then it comes and uninverts. That slowdown of the uninversion is when gold and silver take off. So it goes from an inverted state to an uninverted state, or however you want to do it, an inverted state to uninverted state. And gold goes up and silver goes up. And that front runs money flows. So in COVID, when they shut the economy down, you got that sell everything liquidity type event where everything dropped. And then gold took off. And then whenever they do stimulus on top of it, that supercharges gold and silver in the beginning. That's your 2008. In 2008, they also did stimulus, a bunch of stimulus that ran it to 2011. They did a bunch of stimulus in 2020 that ran it up. And then when that money takes time, it takes time to get into the system and work its way through the system. That's when energy goes up because there's a lag between the money creation and the money kind of filtering through the system and getting into oil. And oil is just a derivative of everything because oil is the energy feedstock, and it's also the number one commodity of feeding like plastics and all that other stuff. So as the money goes into the system, it creates demand, and then it yanks all this stuff off the shelves and says go produce more, which is more or less more demand for oil. So it just takes time to get through the system and work its way to oil. So I think gold goes first, and silver, which it already is moving, and then I think oil is going to follow behind it. So one could state that the bottom occurred in October of 2022. We started moving on up in gold, and we could see oil follow behind it, so long that the yield curve doesn't really uninvert, because if it uninverts, most of the time you see a slowdown in the market. And that's where I don't know the answer, because we're like right on the cusp of uninverting and or staying inverted, and that's where the big question marks are at. Are we going to get a slowdown, or are we going to stay inverted for a
Can
while
I just
longer?
interject here? There's
So,
this
mhm.
debate about what's going to happen next, and about which commodities are going to see big gains when. We can bypass all of that because I think Pat's kind of touched on this point. You really just need, well, he mentioned two charts, gold and S&P. Okay, using those two charts, if you are thinking of buying something, if you're thinking of entering a market, compare it to those two charts. If you're thinking of, I don't know, platinum or platinum miners, for example, because people are talking about platinum, people talk about uranium miners, whatever is the flavor of the moment. Run the ratio chart, platinum to gold, platinum to SPX, because the only time to buy platinum is when it's beating whichever is winning between gold and SPX. So if gold is outperforming the S&P, gold is your gold standard. And whatever you're thinking of entering, whatever you're thinking of buying, whether it's tin, aluminium, oil, platinum, uranium, whatever the heck it is, lumber, corn, wheat, soybeans, if it's not beating gold, if it hasn't broken out versus gold, just forget it. Just keep it on your watch list, set an alert at the point where the breakout point is, and go back to it when it breaks out. When it breaks out, then you take your position. But there's absolutely zero point in even looking at platinum at the moment. I mean, it's been selling off and selling off and selling off and doing absolutely nothing and going nowhere. And when you compare it to gold, because gold's been in an uptrend, gold has completely obliterated platinum. So when people say to me, "Oh, what about platinum? What about platinum?" It's so low, it's so low, it's got to go up. Yeah, well, okay, it can go up, but if it's not going up more quickly than gold, what the hell are you doing having a position in platinum? Wait till it outperforms platinum. Just use that's what a ratio chart is, right? If you haven't heard ratio charts, if you're watching this thinking, what the hell are they talking about? It just compares two assets and it tells you which one of them is either gaining the most or losing the least. In a bear market, gold can outperform silver and its ratio can go up. Doesn't mean gold is going up. It just means it's losing less in dollar terms than silver is. Its relative value is holding more than silver. It might lose 20% to silver's 40% loss. Okay, so a ratio chart will help you to lose the least and gain the most. And at the moment, gold is doing just absolutely great. Pat's mentioned it's in a bull market. It's above all its its long-term moving averages. Gold is going sideways versus the S&P. Even the S&P cannot outperform gold and hasn't done for 6 years. So gold is great. You can just use the gold chart and run your ratio of whatever you're wanting to take a position in versus gold. If it's not beating it, forget it.
There's one caveat to that. It's the dividend adjusted thing there.
Oh yeah, yes, absolutely. Yeah, thanks, Pat, for mentioning that. Of course,
There's always that, It's of course
and
you could
also the fact that gold doesn't pay. Um, so yeah, I mean, to do with the trading costs as well. So if you're entering and exiting and trading, then there's the trading cost to be factored into all of this as well. So, but that's going to be the same whether you're trading stocks or whether you're trading gold. But yeah, of course, dividends makes a
there's
difference.
another chart you're talking about platinum there,
And not
but
all stocks pay dividends, of course.
not all stocks. I don't even know, like the index SPX, if you buy it, is there like a dividend adjusted version of the SPX? Probably, right? Because there's companies in there, but it's not huge dividends. It's not like, it's going to be 2-3% over long periods of time. If you hold the SPX and reinvest the dividends, it's gonna skew it more in its favor, but over long periods of time. But I just had a chart there in my mind. A disaster, like people, if you try to catch the bottom in palladium is worth less than platinum now. Can you realize that? It's like, who remembers palladium could do no wrong, was over 2000 palladium. Remember that thing? And now I think it's worth less than platinum. It's crazy.
And platinum always used to be worth more than gold. I
Than
remember,
gold.
many years
Yeah.
ago, platinum was always worth
Yeah.
more than gold.
These ratios, they might never come back to those levels. Like palladium is just like, who tried to catch a palladium at 1800, at 1600, at 1400, at 1200? Now it's sub 900 or sub 1000 palladium. Like
And
crazy, crazy.
that's the problem with trying to catch bottoms because unless it's outperforming SPX or gold, then you're almost setting yourself up for a disaster. You're kind of admitting failure before you even start. Because why bet on the slowest horse in a race? You're betting that it's not running to the glue factory.
Yes, but Kevin, I know that I have my doctor. He's gonna give the horse steroids, and it will win. I know that. I could bet on that horse.
Works every time,
I know the doctor.
doesn't
Well, you need inside information. Seriously, I know all this is, but somebody has definite 100% inside information. Of course, they could probably like do some crazy things and catch that bottom, right? They have better probabilities of that really being a bottom, right? As a chart trader, it's harder because we need evidence, right? We need to make sure there's some type of uptrend. Goodness, because if there's not even a small uptrend, goodness, I'm in a downtrend, right? Or sideways move.
Right.
What are the hard questions, Danny? What are the hard questions? You're not challenging us today.
Okay. All right. Well, what about uranium? What do you guys think about uranium?
Pat sent me a chart, a uranium chart today, and I won't tell you what he said.
Uranium, it's the uranium bulls, the fundamental uranium bulls are one crazy bunch, man. It's like what do you do? I put it on Twitter there. I didn't mention uranium, but I was thinking of uranium, but it could have been any other asset classes. What do you do when the fundamentals you've been fed are still bullish, but the price is losing momentum, the price is crumbling, the price is starting to roll over? What do you do with that? It's like that's what's happening to uranium right now. It's in 100% a correction period. It's been for a while. It's like it's deepening now. It's losing the longer term momentum. It's still in an uptrend in a very longer term, but it's starting to. I don't know how much time it's going to need to get out of this rut there. 6 months, a year, like it's not guaranteed that thing's going to turn up right now.
Well, if you look at the URA chart, I won't bother pulling it up. But if you look at the URA chart, it's sitting right on the 3-year moving
Can you
average.
show us, Kevin?
Okay,
If you don't mind, I want to see the
wasn't sure
visual.
how much time people. Yeah, okay.
I'm sure they appreciate. I was thinking more of the metal itself there.
Well, I can show both, but the URA chart is sitting right on its 3-year moving average. I'll just expand the chart out so you can see it there. Let me put the moving averages on. Hold on. Right, there you go. I've got all the indicators on there. So that green line there that you see, if I zoom right in, I'll zoom right in there. This green line here, that's the 3-year moving average, and the price has just back tested the 3-year moving average as it did here in last year, in fact, and it was the breakout above the 3-year moving average back in 2020 that signaled the start of the bull market. So 3-year moving average is important to the uranium miners index, the URA index, and it's sitting on that 3-year moving average. So if it was to fall below $24, then I would have much more serious concerns. At the moment, it's a case of hope and pray that 3-year moving average holds and price bounces back and continues in its bull market. But I've been showing this chart for years now, and that label on the chart there that says in a severe correction or market panic, this outer arc should give support. That has been there throughout, because that outer arc is created by the COVID lows back in 2020. So it's like an ultimate support level, if you like. It kind of coincides with where the Ichimoku cloud is at the moment, this green splodge on the chart. So you've got a number of sort of support levels here, but I really wouldn't want to see it falling below the 3-year moving average at all. If it did, I'd be more seriously concerned. But as Pat said, the sideways consolidation, correction, whatever you want to call it, has been in progress for quite some time now, and all of that ties in with the price of the metal itself, the spot price of uranium futures. When you look at that chart, you can see that it hit its target. The price of the metal hit its target. If you remember back in early part of this year, there are certain accounts on social media that were going absolutely ballistic about how, the spot price of the metal was heading, I don't know, wherever, 130, 140, 150. It was going to go back to where it was in 2007. Well, the chart wasn't really suggesting that as the high probability outcome. It was suggesting that the high probability outcome would be where this arc target area is. We hit the target area, and since then we've been pulling back towards the edge of the arc. So $73 is plausible for the spot price of uranium, and until it breaks out back clearly above $100, I wouldn't be convinced of anything, because you could see this correction continue for an extended period of time. We just don't know whether we're going to see a handle forming on this, or whether the price is just going to turn around and catapult upwards. But the main point of the chart is that the profit-taking zone has been hit, the target has been hit, and now it's a case of take your profits, sit and wait, which is exactly what we did. So that's uranium. It doesn't look too pretty at the moment, but on those long-term perspectives, it hasn't broken below critical support.
Okay. Well, Andy, what do you think?
Yeah, in the short term, it does look pretty weak momentum wise. It probably has to base out before it's going to move higher, is my guess. So you got this big selling pressure move, and it's probably going to have to consolidate, form some sort of base, and then eventually turn around. But longer term, I do think that the conditions that are coming will be ripe for commodities in general. I think it's just another extension showing us that we could potentially have a slowdown in the short term. Uranium's being impacted, Bitcoin's kind of rolling over. Sometimes uranium and technology stocks kind of link up together. And I think that's kind of what's happening here in the short term. So I think a potential slowdown is definitely possible of the overall market. I think uranium is just kind of signaling that too. But yeah, it's definitely not in favor at this time. And sentiment is really bad in it. I'll say that. So I think eventually we'll get a bottom at some point here, probably pretty soon.
Gotcha.
It's
Well, it's been over an hour, guys. Anything else you want to
goodness.
talk about? Did you want to say something, Patrick?
No, I was good. Just rambled on. It's fine.
Oh, go right ahead. The floor is yours.
Well, just like silver and gold are going to do the last hurrah. Like they open up the show, and all these other commodities. Let's say there is a slowdown. Gold's probably and silver are probably going to last two that are going to roll over. So if uranium's starting to slow down, if oil's starting to slow down, you see even copper slowing down. There's sugar that's slowed down. There's cocoa, like a whole bunch. Like Kevin said, that like a lot of commodities, they're all slowing down. And if there is a slowdown, then the yield curve uninverts, but it's still possible that silver and gold will go for one last hurrah, then get dragged down, and then after that, reopen the gateways. But this time, hopefully, when they reopen the gateways, it will be accompanied with a breakout versus SPX. And then that's when all commodities really flourish. Really, like what we've seen now for uranium is baby juice. It's nothing compared to what's going to happen next once gold breaks out. People don't understand this. It's nothing what happened to uranium. All these moves, copper, oil, like oil could be at $300 in 10 years. Goodness, like this stuff is it's nothing what we've seen right now. These rallies we've had in all these commodities, it's nothing compared to what's going to happen next. It's like that's what I'm trying to tell people. You're not leaving late. Whoever played now, it's fine. It's early, but with the true weight of evidence, we're not even. I don't think we're it's haven't hasn't even started yet.
Thanks, Patrick.
Yeah,
I
and that,
appreciate
and
I
that
appreciate the clickbait.
yeah. What did you say? Baby juice. So I
I
quite
know
like
what's that about baby juice. What like it's like
that.
sometimes because my brain thinks in French, and it's probably like an expression in French, and I just my brain tries translates the words, but then I realize that it doesn't make sense in English. Like
I
juice,
totally agree. No,
like
I totally agree. Silver at $50 isn't even getting started because we could have $50 silver and $3,000 gold
But the question,
at the point that sorry, I was going to say 3,050 at the point that it actually breaks out versus the S&P. So that's the starting point, not the end.
yeah, but the question I anticipate would be on the minds of the audience is how long until we get to that point, though? Because some people have been waiting for 4, 5, 6, 7, 8 years.
well, they
But
shouldn't be waiting.
waiting gold. Wait, if you're waiting, you could have already made 50% in gold because it's moved from 1,600 to 2,500. If there's no need to wait on the sidelines if that's what you're sort of saying. Look at the charts and play the charts. Gold is in a clear uptrend, so there's no need to wait. You can be making good money in gold or in the stock market because gold and stock market have performed equally for the last 6 years. So you could have made good money in both. What we're saying is that the capital rotation event will be confirmed by gold breaking out versus the S&P and moving above zero point 0.5. So once gold is worth 50% of the stock market, that's when you can really start thinking in terms of the true gold bull era, not bull market, but bull era, commodities bull era, that capital rotation taking place. There's no point really trying to put an exact date on it. You can look at the charts and you can see how long it might potentially take. It could potentially take 2, 3 years for that to happen, but it may occur in the next 6 months. But there's no need to sort of spend a lot of time thinking about that. Just play the charts that are in front of you
Gotcha.
would be my suggestion. I mean, my feeling is that the rollover, if it's going to occur, assuming that the roadmap plays out, is likely to happen in the next sort of 6 to 12 months. But my original feelings were that it would probably happen late this year, but it could well extend beyond that into next year. Who knows?
All right. Well, fantastic talk, guys. Let's go around the horn here, and any concluding thoughts, and tell people where they can find you. Andy.
Yeah, so I've got a YouTube channel, Finding Value Finance. You can see stuff that I put on there. It's mainly commodity related. And then I also have a website, finding-value.com, where I dive deeper into all of these things, looking for potential investment opportunities. And you can see kind of what I'm doing during this commodity bull market and how I'm positioning for it. And I usually go after the more leverage stuff, kind of the small mid cap range where the risk is good and looking for high potential upside returns.
Great.
So,
Yeah, Kevin, Patrick, we'll have a link to your website also down below in the description, so be sure to check it out, guys. Kevin, Patrick, any closing thoughts?
Oh, I think we pretty much covered just about everything there as far as I'm concerned. Yeah.
Just watch those big picture ratio charts and be on the good side of the trend there. The trend
Yeah, and
is
a good piece of advice we mentioned before, and being more serious, Danny, is risk and money management. I haven't mentioned it this time around, but please, if you're new to all of this and you're watching this and you haven't really sort of had a lot of experience with trading, investing, use risk and money management. Learn about risk and money management because it'll protect you. For example, if a stock falls 50%, you can perhaps see a drawdown of 1% on your NAV. If you're using risk and money management, it allows you to sleep at night. So careful risk and money management just to make sure that if the markets do roll over and you're asleep at the time, all your stop losses get hit and you lose a very small percentage and not a huge amount.
Yeah. Great stuff, guys. If you enjoyed this content, if you found value out of this video, hit that subscribe button. It goes a long way and it's free. And also, if you'd like to, buy gold, please consider my partner at Miles Franklin. Email them at info@milesfranklin.com and tell them that Capital Cosm sent you in the subject line. And when you do that, you'll get their special pricing that you're not going to find on their website. You've got to email them to get the special pricing, so be sure to do so. Like the video, comment down below. What do you guys think? Do you agree or disagree with any of the guests' take today? Really interested to get your thoughts, actually. It seems like we all tend to be on the same page, but really interested to get some dissenting thoughts in the comments down below. And I think that's it. Guys, thanks so much for coming on.
Good stuff. Always a pleasure.
All right, and
All
thank
right. Bye,
you.
guys.
And
Bye,
thank you for
Andy,
watching.
Danny.
All right, see ya.
Kev.